Hi, welcome back to Joe Blogs. In this short episode, I want to talk to you about the latest jobs data that was released in the USA. At face value, that press release looks like fantastic news. In September, there were 336,000 new jobs created, compared with 227,000 in August, and the expectations from the market of around 200,000. And in terms of what people in employment are currently being paid, the year-on-year increase is 4.2%. So you would think that all of that shows that the US economy is doing really well and that everything is on the up. But the reason that this represents bad news, not just for the USA, but also for the global economy, is that these figures are actually too good. They are way better than everybody was hoping for. And what that means is that the Fed may now decide that they need to do something to cool things down, because the Fed is still laser focused on getting inflation down to its target level of 2%. Now, the official current rate of inflation is 3.7%, so somewhere above the 2%, but everything's moving generally in the right direction. But in terms of the target level of new jobs, the Fed only needs 100,000 jobs to be created each month to keep the economy at equilibrium, and it's looking for wage increases of 3.5% to hit that 2% inflation target. So the fact that the US job market is doing so well and is so buoyant means that there's now a much higher risk that the Fed is going to increase interest rates before the end of 2023. Now, in terms of the market expectations, everybody thought that the Fed was done, that we wouldn't need any more rate increases, and actually we may start seeing some rate reductions coming through in 2024. So rate expectations have now gone back up, and the problem that that represents in terms of the USA and also the global economy is that it's going to increase the refinancing cost for all of the trillions of dollars of loans and bonds that are currently waiting to be refinanced by major corporates. And a lot of these corporates have been referred to as zombies because they're carrying around large amounts of debt that they can't afford to repay, and they need to refinance it. But the problem that a lot of these businesses have is that they're struggling to be able to pay the interest. And a lot of companies issued these bonds 5 or 10 years ago when interest rates were virtually zero. So they're paying a really low coupon on the existing debt. But when it comes to refinancing that debt, they'll have to do that at the current rates. And the current official rate of interest in the USA is now 5.5%, compared with 0.5% 10 years ago. So what that means is that a lot of companies could see an increase in their interest cost of up to 10 times. And there is no way on earth that any of these companies are going to be able to afford that. So we're going to see a whole wave of restructurings, possibly some write-downs of debt, possibly companies going into liquidation or Chapter 11. But the bottom line is that we could see a whole lot of defaults happening over the course of the next 12 to 18 months. And that will have a major ripple impact because the companies who are holding that debt won't get paid back all of their debt. So therefore, they'll make a less profit. They won't have as much money to be able to pay their employees or the people that they owe money to. And so we could see a real domino effect, not just in the USA, but all around the world, because companies with huge amounts of debt are sitting virtually everywhere. And we've seen interest rates going up dramatically over the course of the last couple of years. So this is a time bomb waiting to go off. So I wanted to post this video really to give you the heads up that whenever you see information in the press, don't take it at face value. Just because you read a headline saying that US jobs are up significantly, much better than expected, you may think that that's good news and everything looks rosy in the garden. But unfortunately, in reality, data can be too good, particularly when it has a link to inflation and what's going on right now. And as I said, the Fed is laser focused on bringing inflation down to its manageable level. So if things keep going the way they're going in the US right now, it's very likely that the Fed will increase its rates. That will have a knock-on impact to Europe and other places around the world. It's likely that they'll also see increases in their rates, and that's going to be disastrous for all of these zombie corporates who are carrying around this unmanageable debt. So hopefully you enjoyed this shorter version. If you're interested in looking at this in more detail, I've actually posted a long form version of this same video. So if you want to dive deeper into all of this information and find out which countries are currently in recession and which are on the verge of recession, then please check out that video. But even if you don't want to do that, thanks for watching this video and I'll see you again soon.